Aloha class, this is a video for M8-3, and we're talking about Chapter 8, which includes understanding the business pros and cons of extending credit, accounting for accounts receivable and bad debts, and methods for estimating bad debts. There's definitely pros and cons, so we can have increased sales revenue, but there's also increased wage costs for hiring somebody that can manage your credit. Some people just don't pay us, so we have bad debt costs, and then there can be a delayed receipt of cash, so that we're not as liquid if the cash doesn't come right away. So it can make it harder for us to go acquire more inventory if we're waiting for that cash to come into our business. And so we're talking about expense recognition and the matching principle. And when we have this allowance for doubtful accounts and accounts receivable in general, we want to report accounts receivable at the amount the company expects to collect, or the net accounts receivable. And we want to match the cost of bad debts to the accounting period in which the related credit sales are made. And so instead of the bad debt being discovered at a later period, we want to match those to the period that the revenue was generated. So the expenses are matched to the revenue. So we'll match it into that period one. And to do this, we use the allowance method, a method of accounting that reduces accounts receivable as well as net income for an estimate of uncollectible accounts or bad debts. And we can adjust the estimated bad debts. Remember, this is an estimate based on historical information, or we have two different methods for either the balance sheet method or the net income, the income statement method. So we'll get into that a little bit later. So we're going to do reporting accounts receivable and reporting write-offs using the allowance method. And this problem, it assumes that you've already have these accounts receivable, which means you've made sales. And so we have unadjusted balances of $800,000 in accounts receivable. So I'm going to put that into my T account that I have already made over here. If you need to make a T account, you can merge two cells together, merge and center those cells, and then you can draw lines with this function in Excel. So just draw those borders of lines. And then if you need multiple T accounts, sorry, I don't know if you could see that well. So I've just drawn lines, merged those centers. You can just copy and paste this down and make multiple T accounts as needed. So I'm going to get rid of this T account because I've already made my T accounts. And then the allowance for doubtful accounts is $55,000. And remember, this is a contra asset, or decreases the value of our accounts receivable. So this contra asset has a $55,000 balance, and it would have a normal credit balance. It can have a debit balance if we don't adjust it enough, but normally it has a credit balance. Okay, on January 2nd, 2021, the company learns that certain customer accounts are not collectible, so management authorizes a write-off of these accounts totaling $10,000. Show how the company would have reported its receivable amount on December 31st, 2021 as of the date. What amount did Extreme Fitness expect to collect? Okay, so they've already set up this accounts receivable. They've made the sale as well as their allowance for doubtful accounts, which would be normally a debit to bad debt expense, credit allowance for doubtful accounts. So this is how you would first set up your allowance for doubtful accounts, which they've already done. And so if we look at our balance sheet, it's under assets, we have our cash, and then the next one is usually accounts receivable, or there can be a few things in between those, but accounts receivable less allowance for doubtful accounts gives you accounts receivable net. And with this, I would have accounts receivable, just the account balance. So I can just use this $800,000 for my account balance and put a line under here. And then I would have $55,000. So I could sum up, and the correct formula would be to sum all of the left side, the sum of all the debits minus the sum of all of the credits, because this is a normal debit balance. And then for the allowance, I will sum all the credits, and I will subtract the sum all of the debits. Okay, so now I would present it as $800,000 and allowance for doubtful accounts $55,000. So the net amount of receivables, which is accounts receivable less allowance for doubtful accounts, contra asset. So accounts receivable net on the balance sheet as of December 31st, 2021, balance sheet. This is just for accounts receivable. And then this is for extreme fitness company. So that's what you would put for December 31st. But then remember that they know now on January 2nd that the customer accounts for 10,000 are not collectible. So management is going to authorize a write-off of these accounts. So we're not going to collect them. And so we need to adjust our allowance for doubtful accounts and our accounts receivable. So these are not going to be collected. We're going to remove or write off specific customer account balances. So that's what our journal entry will be. We will debit our allowance for doubtful accounts and credit our accounts receivable. So this is a subtracting a contra asset and that as a debit, and then this would be lowering or decreasing a contra asset and decreasing an asset. Okay, so 10,000 is going to go bad, so we're going to write it off. So we're actually in the second step. So they've already made this estimate end of period adjustment. This was the adjustment with bad debt expense debit, credit your allowance for doubtful accounts. And now we're going to remove specific customer balances when they are known to be uncollectible. So this one was known to be uncollectible. We'd make this journal entry. And now with this journal entry, I'd post to my T accounts. And so with this posting, I would credit my accounts receivable by 10,000, and I would debit my allowance for doubtful accounts. Okay, so I should probably copy and paste this values. So those don't change. That's December 31st. And then I'll redo that to make sure at January 2nd, I have the right amounts. So now when I zoom in here, my accounts receivable balance is not going to be 800,000. It's going to be 790,000 accounts receivable. And I'm going to have an allowance for doubtful accounts of 45,000. So when I do accounts receivable less allowance for doubtful accounts, so they're still going to have this net receivable of 745,000, right? So it's exactly the same, but we can see that 10,000 was accounted for by our estimate of allowance for doubtful accounts. So it says, has it changed? Assuming no other transactions, show how Extreme Fitness would have reported its account receivable as of January 3rd. So this happened on January 2nd, January 3rd. As of the date, what amount would Extreme Fitness expect to collect? It's exactly the same amount, and it's accounted for based on that allowance for doubtful accounts that came in. And so that's your answer for this last part of this problem. And that's a little bit about how we're going to account for those bad debts that go, or the accounts receivable that become uncollectible, so we have to write them off.